Keith, it's good to see you. So just give me your first thoughts on what you're seeing. We are well off the lows of the session, but still, we're seeing pretty intense pressure across the board.
Yeah, great to be with you. I wish we had more green on the board. It's been an ugly Monday after an ugly Friday. So here, big picture for us is before this sell-off, our view is when you have these strong first halves, you tend to see a pullback in the second half around the average 9%. It could be higher or lower. So around that today. I do feel like on a short-term basis, things it's starting to feel a little bit panicky. You mentioned the VIX, one of the highest spikes ever. I'm not here to call a low, right? It's hard to say when the low will be there, but I will say, historically, when you've seen the VIX move up by more than 15 points, and it's only happened about 4 or 5 times, when you look out a year out, you've been up every time. Now, Sean, one period that's interesting that I looked at was the 2018 period, where it was Fed related, but it was the other way. The people were concerned about the Fed moving the economy moving too hot. You did have a spike in the VIX. You made a lower low, and then you actually chopped around, but you did rebound. And I think that's a good template for what we're going to see going forward.
Keith, there are a lot of investors out there that look at a dip like this over the past several sessions here in aggregate and trying to figure out, okay, where does this present buying opportunity? Where are you looking across your own kind of investment landscape and portfolio landscape and saying, okay, here's what we've been waiting for to buy further into?
Yeah, well, at this point, we've been thinking we were going in a choppy period. I want to see after today if our indicators get to the extremes. Like as of Friday, we were telling our clients, like the technology sector had not moved to an extreme as of yet, even after they oversold. So we're going to be looking closely at that sector's at the 200-day moving average today. The S&P, our best estimate is that the downside from here is probably limited to about 4 to 5%. So, I mean, if you have a longer-term horizon, I think just more generally being in the overall market, I don't know that, again, being aggressive here, I think we might have a little bit further to go, but dipping your toe in if you had some cash on the sidelines. And I do think one area that we'll be focused on is tech. Again, is it the low today? It's premature to say that, but I think the risk reward is actually improving as you move back and you're taking off some of that complacency from the market. And the market had been pretty complacent into this number.
Keith, what do you think is going to be the catalyst for that reversal that maybe we could see once we are going to see some of that momentum return here to the market?
Yeah, well, to be fair, I actually think we're going to be in an extended period of choppier waters because what tends to happen after you have a quick move down in the market and a volatility spike, that tells you that market participants were off sides. So then what tends to happen is you have a cluster of strong up days, strong down days, because there's a battle between fear and greed. And as opposed to just going back to new highs, you tend to go back and forth, making it frustrated on both sides. I think you have to get kind of past through August. From the bullish side, you want to see that things like the initial jobless claims, like the services this morning that actually confirm that the economy isn't heading into recession, and you get closer to when the Fed would likely cut rates. I think the challenge today is that the Fed isn't meeting for another 6 weeks. Yes, they can cut intra-market or intra-meeting, I should say, but typically they don't want to set off, perception that there's panic there. So I do think that this is going to take some time, and patience will be a virtue until we, I think, get past this. The economy confirms itself, and it will probably be later in the fall before we actually make a lot of headway to the upside.
Do you think that the Fed should institute a 50 basis point cut? The probability is moving that direction, at least from what we've seen in the CME FedWatch data.
Yes, we do, and that's a base case now is that September you'll see a 50 basis point cut. If you think about it, for so long the Fed was so focused on one side of the mandate on inflation. Well, the PCE, their core preferred measure, is around 2.5%. So now they should be squarely focused on the other side of their mandate, which is employment and the economy, and that's obviously showing some cooling here recently. So we think they need to get on with it. We think by most measures, almost any metric, you are still restrictive. So I think it's important that they start moving in that direction. But again, we might be in a little bit of a waiting period for them to do so. And that just causes the market to have some jitteriness. But again, I mean, the good news is at least you're moving more towards an oversold and discounting some of the uncertainties, which weren't being discounted well, I'll say, a week ago.
Keith, where do you think that leaves the Fed then as you look ahead to the remainder of the year? So past the September meeting, when you look ahead to November, when you look ahead to December, I guess how aggressive do you see the Fed needing to get then at that point?
I think as a base case, we would say a total of 100 basis point cuts this year, maybe a 50 and then 2 quarters. But to be fair, I mean, we have, the employment report that we had on Friday that really got the market's attention. that gets revised 2-3 times. So, I mean, unfortunately, it will be data dependent, right? The 3-month trend for the employment, by the way, right now is about 170,000. That's just back to the pre-pandemic trend. So by itself, the trend is cooling, but it's not weak relative to history. So I think it's going to be obviously data dependent, but our base case is 100 basis point cut from here.